A massive spike on the gold chart pulls you in, then violently crashes, leaving behind a massive wick that stops out your trade. Spending your lunch break staring at a 5-minute chart trying to chase momentum is exactly what the market wants you to do. Reacting to these aggressive green candles, retail traders provide the fuel for the market's next move. The algorithms driving this market have immense capital and volume behind them. They require substantial liquidity to fill their orders without causing extreme price slippage, which means they have to engineer these traps. To survive trading gold with a full-time schedule, you must stop reacting to the current candle. You need to anticipate where price is going by using a strict 10-minute daily routine based on smart money concepts. Constraining your analysis to a 600-second window forces you to filter out lower timeframe noise. This routine helps you identify the high timeframe levels that act as the primary targets of the day's move before your workday even begins. The first step in this 10-minute window is identifying the draw on liquidity on your daily or 4-hour chart. This is the obvious price level, like last week's high or a massive unmitigated gap where retail stop losses are resting. This diagram displays how we frame that narrative. By measuring from a recent structural swing low to a swing high, you draw a 50% line to find the equilibrium. The upper half is the premium zone, and the lower half is the discount zone. The ironclad rule of this routine is simple. Never buy gold in the premium zone, and never sell it in the discount zone. Buying an expensive asset means you are the exact liquidity smart money is using to exit their positions. Institutional algorithms are programmed to accumulate their massive positions exclusively when the asset is cheap. They buy in the discount zone. Locking in this macro equilibrium is your mandatory safety check. It ensures that when you drop down to lower timeframes to look for entries, you are swimming with the algorithms instead of fighting against them. With the narrative set, the clock officially starts. You spend minutes 1 through 3 scanning the 1-hour chart for a clear break of structure where a full candle body closes above a previous high. In minutes 4 through 7, you hunt inside your discount zone for high-probability points of interest. You are looking for fair value gaps, which are gaps left behind by aggressive institutional buying that directly overlap with an unmitigated order block. Because gold is priced in dollars, the US dollar index, or DXY, provides a direct correlation filter. If gold enters your buying zone while the dollar is simultaneously hitting a resistance level, the probability of your setup increases significantly. This split-screen chart illustrates SMT divergence. When gold pushes to a new low but the DXY fails to mirror it with a higher high, the standard inverse relationship is breaking. This decoupling reveals that despite the dollar's movement, aggressive buyers are stepping in to hold gold's price, signaling institutional accumulation. Applying this dollar filter to your gold analysis strips away the low probability zones, leaving you with setups that have true institutional backing. We are now in minutes 8 through 10. It is time to prepare for gold's signature behavior, the stop hunt. Look at the schematic. Retail traders place their stop losses directly below obvious levels like equal lows. Algorithms intentionally push price down to trigger those stops, grab the necessary liquidity inside an order block, and then violently reverse direction. Gold has a massive average true range, meaning it swings wildly before settling into a trend. To account for this, you have to apply the breathing room concept to your alerts. You set your alert slightly before the actual point of interest. When price crosses your alert line, you have a physical buffer of time to open your phone, read the momentum, and assess the trap as it forms. Anticipating this sweep and building in that visual buffer prevents you from getting wicked out of a trade just seconds before a massive expansion happens. Your 10 minutes are up, your zones are marked, and your alerts are set. The most profitable thing you can do right now is close your laptop and go about your day. What you just completed in the morning is your analysis. That is a completely separate discipline from your execution. When your alert finally fires later in the day, you check the 1-minute chart. You wait for price to enter your marked zone and show a clear shift in momentum. If price slices straight through your zone with heavy volume, you do nothing, and you save yourself a loss. I challenge you to apply this exact constraint for the next 21 days. Map your charts in 10 minutes and refuse to take a single trade outside of those pre-marked institutional zones. You can download our 10-minute gold marking checklist from the description below to start this process tomorrow morning. And to capitalize on the raw spreads and fast execution speeds this asset demands, trade your setups on FXNX.